Financial markets are the meeting place for people, corporations, and institutions that either need money or have money to lend or invest. Public financial markets are those markets for governments to borrow funds for public activities. And corporate financial markets are those markets for corporations to raise funds. There are different types of financial markets where financial managers can raise funds. Money markets are those markets dealing with short-term securities that have a life of 1 year or less. Securities in money markets can include treasury bills offered by the federal or provincial government, commercial paper sold by corporations to finance their daily operations, or certificates of deposit with maturities of less than 1 year sold by banks. Capital markets are generally defined as those markets in which securities have a life of more than 1 year. The capital markets include securities such as common stock, preferred stock, and corporate and government bonds. Corporations rely on the financial markets to raise capital to fund their expansion and growth. They can do this in one of two ways: either by borrowing money through a debt offering of corporate bonds or short-term notes, or by selling ownership in the company through an issue of common stock. When a corporation uses the financial markets to raise new funds, the sale of securities is said to be made in the primary market by way of a new issue, such as with an IPO or an initial public offering. After the securities are sold to the public, they are traded in the secondary market between investors. Your job as a finance manager is to try to maximize return and minimize risk with your company's investments. Securities with the potential for higher profitability and returns will be bid up in price and carry with it higher risk. Securities which are less profitable carry less risk. For example, investing in stocks may be more profitable than investing in a savings account, but there is greater risk of loss with the stock security than the safer savings account. As the market rewards companies with higher priced securities, those companies will have an easier time raising new funds than their competitors. They are also able to raise funds at a lower cost. Suppose a top-notch blue-chip company with a proven track record wants to borrow money from you at 8%, and a recent startup untested tech company is willing to pay 8%, but is also riskier. Which company will you lend money to? The competition between the two firms for your funds will eventually cause the startup company to either offer higher returns than the proven company or go without funds. In the same way, the financial markets allocate funds efficiently to the highest quality companies at the lower cost and to the lowest quality companies at the higher cost. As a financial manager assesses risk and its impact on the company value, there are several considerations. Debt is an important component of a firm's capital structure. However, too much debt can erode the firm's ability to be able to generate enough cash flow to cover its interest expenses, which then increases the firm's risk. Interest rates are the rates of return required on investments that help establish where people allocate their money. Lower, more stable interest rates can drive investors to place higher values on corporate securities and putting their money into stocks and bonds. Furthermore, lower rates can also result in cheaper financing for a company's new capital projects, thereby reducing their risk. Inflation is a major determinant of interest rates. Inflation can be measured by the changes in the Consumer Price Index. Interest rates respond to inflation. When prices in an economy rise, the central bank typically raises its target interest rate to cool down an overheating economy and prevent consumer prices from getting out of hand. There is greater risk as the central bank allows the spread between inflation and interest rates to increase before responding with new measures.